property. So I'll go through that as well, and go through a number of different things today. So really to get started, I'll go through the table of contents here. I'm going to talk about creating a game plan for yourself, making sure that you sort out your residence, the power of leverage, talking about what a HELOC is and how it can help you build your real estate portfolio, how to buy properties number 2 to 3, how lenders qualify rental properties, buying properties 4 to 5, and then going into a little bit about what the banks don't tell you. So some of the things and things that you need to watch out for. It's very common that you'll start buying properties. The bank says, no problem, just come back and we'll get the next one sorted out for you. And then all of a sudden you do bring that one property to them and they say, oh, yeah, actually, you don't qualify because of this reason or that reason. So I'm trying to map out the challenges that you will face and the walls you will hit before you hit them, so you can have a really solid plan in place to build your real estate portfolio. And then I'll go into some quick tips, and then I'll open up for some questions at the end. So first of all, step number 1, creating a plan. You want to create a plan and set yourself up and make sure that, that you know exactly where you want to be. The reality is that every game plan can be very, very different. And so what a lot of people do, of course, they usually start off with the residence, and then they buy their first rental. Maybe they get up to 5 properties, 5 rentals, and then maybe they start going into over 5, maybe they start getting into commercial lending. The reality is every single portfolio and every single game plan is different. Some people really want to build it and scale up and buy a large number of properties, but some people just want to buy one rental property. One really common example that I actually see a lot is when people are coming to us to buy their first rental property. A lot of the time they come and say, hey, Kyle, we really need the best interest rate. That's the main focus. And for a good reason. Usually when you're buying your residence, and especially if you're a first-time home buyer, that's one of the most important value propositions of getting your first home, is just getting a low interest rate and paying the least amount of interest. However, if you ask an investor who has 10 rental properties, what's the most important thing to them? It's probably, yes, interest rate obviously is relevant and important, but all of a sudden access to capital is probably one of the most important things. As long as you can access capital at a reasonable interest rate, paying 1.1 or 0.2% extra on the rate, but being able to borrow an extra $100,000 or $200,000 is probably going to actually generate more of a more benefit and generate a higher net worth overall. And so I think things start to change. Creating that game plan can take some time, and one of the things that we can help is by closing some doors, looking at what is actually feasible and what is not. But usually you have to connect the dots and say, okay, what would you like to, in a perfect world, what would you like to do? What would you like to buy? How many properties do you have and how many years? Where would you like to buy? What would you like to buy? And generally the financial reality of how much you can actually qualify for starts to set in, and then we end up closing some doors, but it allows you to have more of a laser focused on what is possible and what is not possible. So once you have your game plan, step 2 is usually to own your own home, or to access the leverage and access the equity in your home to be able to pull out and use to parlay into real estate investments. So generally speaking, owning your own home is the first thing that you do once you've created your game plan. And one of the reasons that you should be looking at doing this is, why invest in real estate? 90% of all millionaires became so by owning real estate. And I must say that probably, especially if you look at like Vancouver, for instance, probably 90% of the millionaires in Vancouver are millionaires just because they've bought a home 20 years ago. It's definitely not rocket science, especially in major urban centers across Canada. This is one of the easiest ways to build wealth, and owning your own home is one of the best ways of doing that. And the primary reason is generally the leverage. Leverage is probably one of the most important aspects of investing in real estate. One of the main reasons for this is that if you're buying your first home, in fact, you don't even need to be a first-time home buyer, but you're buying a primary residence, you can buy it as little as 5% down. And you can also do this for second homes as well. One thing that you do need to keep in mind is if you're putting less than 20% down, then the home value needs to be under $1 million. So CMHC and the other 2 mortgage insurers in Canada will not insure homes where the value is over $1 million. So that's something that you need to keep in mind. One other thing that I do want to mention here too is that you don't need to be a first-time home buyer to put 5% down. You just need to be buying your own primary residence. And we'll get into a little bit of a strategy in a little bit on how to build a real estate portfolio using less capital than you might expect. Down payment on rentals is 20% down. Now, still, even 20% down is still only putting 1/5 of the property value down. If you're buying a stock, for instance, then generally, unless you're doing a short or some kind of marginal investment, then generally speaking, you're buying the entire stock with all of your cash, and so it's harder to get leverage in stocks, and much more difficult than it is to do that in real estate. Another key metric here too, with regards to your own home, and this might change in the future, but I don't think it will, is there's no capital gains on the appreciation on a residence. So you do pay capital gains on the appreciation on a rental property, but you do not pay capital gains on the appreciation of a residence, and that's a really important key. People have in many cases, you'll see people making more money on the appreciation of their home, which is tax-free, by the way, than they are making working at their job, which is crazy. But ultimately, at the end of the day, really important to understand that, one of the reasons to own your own home is that it's a solid investment. You get really good leverage on it, and there's no capital gains on the appreciation. So let's map out the leverage aspect. I want to show this and just map this out. Let's say that you're buying a property for $500,000, and we're looking at the leverage if there's a 3% annual appreciation. So if you bought a home for $500,000, and it's a rental purchase, you're putting 20% down, so you're putting $100,000 down. If the home appreciates by $15,000, so that's 3%. It's going up. A $500,000 home goes up by 3%. That's $15,000 in appreciation. Your return on investment is not 3%. It's actually 15%. And the reason for that is that you put 1/5 of the property value down. So every 1% of appreciation represents a 5% return on your money. So if you look at this, the $15,000 in appreciation that you made is not based off of the value. It's based off the amount of money that you put into the deal. It's based off of your investment. That's why they call it the return on investment, not the return on the asset value. Okay, so in this case, if you make $15,000 on your $100,000 investment, you've made $15,000. And so this is really, really cool, especially if you start looking at a primary residence. If you bought a primary residence and the same example, $500,000 property, you put $25,000 down, so 5%, and if the home value appreciates by $15,000, your return on investment is 60%. Yes, that's right, 60%. We've seen certain cases and certain scenarios. We've just been through a scenario just over the last year, and if I rewind and go back to maybe 2015, 2016, we saw similar situations where home values over a 1-year period went up by 30%. I'm looking at some of my old presentations from 2015 and 2016, where I was mentioning that yes, your home value has gone up 30%. What do you do with that equity? I'm preaching the same thing today. Now the crazy thing is, that means if you bought a home with 5% down and the appreciation in that year was 30%, your return on investment over that 1 year was 600%. 600%. So that's a crazy number. I would never say you should expect that, and it is unlikely to continue, obviously. But at the same time, too, something to consider is the fact that it's really hard to get these types of returns in other investment vehicles because of the aspect of leverage. It's a really, really important key. So if we take a look at this now and say, okay, we want to make a $500,000 purchase, we want to figure out what is the strategy here. There's a number of different ways that you can do this. One way is to do this as a first-time home, or not a first-time home buyer, but a home buyer. You can buy with as little as 5% down. Now, one of the things that's important to understand here is how much income is required to do this, because you're going to qualify for a larger loan size because you're borrowing more money. Also, it's on a 25-year amortization and not a 30-year amortization. So although 5% down is doable, it does require an income of about $105,000 a year, household income, with no other debts to qualify for a first home, or a residence, I should say. And if you bought with 20% down as a primary residence, you'd only need about $80,000 in income required, and you would do a 30-year amortization, or could do a 30-year amortization. You can also get a home equity line of credit product too, so it's a better product. And so when you buy your residence, there are two different directions to take, and each have different values, by the way. One is going to require a bit more income to qualify to do it, but you get more leverage. So you're putting only 5% down, which means that now, let's say that you did have the amount of money necessary to make this purchase with 20% down. If you only did 5% down, that just means that you now have that 15% of extra cash available to then use to purchase your next property. So some of our clients that have a really high income but don't have a lot of assets or really want to stretch it out as much as possible might say, okay, I'm going to buy my residence 5% down, and then I still have extra cash that I'm going to then use to buy a rental property later. Those that wanted to do this with less risk might do it with 20% down. You get a better product overall because now you're 30-year amortization, which keeps your payments a little bit lower. And also you get a home equity line of credit. And this home equity line of credit often becomes the hub and the source of how you manage your investments. And so let me show you an example of how a home equity line of credit works. So the HELOC is what's called you may have heard of the term readvanceable mortgage. And one of the cool things about this is it's a way of minimizing your taxes and also being used to invest at the same time. So if I use the same example, a $500,000 value property, and so you started off, if you put 20% down with a $400,000 mortgage, what happens when you get a HELOC, a home equity line of credit, is they approve you for 80% or up to 80% of the home value right off the bat. But that means that between your mortgage and line of credit components, you can be borrowing up to that $400,000 amount at any point in time. So let's say that you started off at a $400,000 mortgage, but now you've slowly over time paid down your mortgage from $400 down to $225. That means that you now have $175,000 available to you on the line of credit. And so if you're paying down that mortgage down to $225, all of this money goes into the line of credit room, and now your line of credit limit increases. Now, the really cool thing about this product is that the money on the left here, the money in red, is your personal mortgage, and that's not tax deductible if it was used to borrow and used to pay for your own residence. The money on the right, however, if you're utilizing this line of credit and reborrowing this money out to invest, then this money is tax deductible. So whenever you borrow money to invest with the intention of earning an income, the cost of borrowing on the interest cost is tax deductible. So not the principal, but the interest is. So this is a really cool product that you're able to take advantage of. And this is one reason why maybe instead of doing just 5% down, you'd say, okay, I don't want to pay the CMHC fees. I do want a 30-year amortization. I want a smaller mortgage. And also I want this product because now you can chip away your mortgage faster, opening up more room in your line of credit, which then you're going to reborrow to invest. And that's the way to build it. And so we do find clients that, especially if you're a little bit later on, where you know exactly where you want to live for an extended period of time. Maybe you have the family home that you intend on staying in for 10 years or longer, and you say, okay, this is where we want to be, then you would want to get a home equity line of credit set up against your residence. And so if you already own your own home, then this is usually the first step after you've created your game plan to start building and creating your investment career. Now, there are some additional tips and tricks that you can learn by reading this book. It's called The Smith Maneuver. Initially, Robinson Smith's father had written the original version. Robinson had gone through and redid it and added a couple of extra little things to it. By the way, we do have a bunch of copies in the office. Anybody would like to read it? There are some what we call accelerators, ways that you can pay down that mortgage and increase the line of credit, and basically just create a larger tax deduction for yourself more quickly. There's a number of copies in the office here. So if you email us at info@greenmortgageteam.ca, we'd be happy to pop a copy in the mail and send it over to you. Now, so the key points with your first property here is it's important not to overextend on your residence. And I'll get into this in a little bit why this is important, but if effectively the more that you borrow on your residence and the less debt servicing room you have available, it's going to be harder for you to buy more rental properties later. So if you max yourself out on the residence, you're not going to leave a lot of room to be able to purchase additional rental properties. In general, we recommend the longest amortization available to you. So if you're putting less than 20% down, then you're looking at a 25-year amortization maximum. But if you have more than 20% down, you can get up to a 30-year amortization. Now, some lenders will charge a slightly higher rate for that 30-year amortization, but I'm telling you right now, that if you drop your payments by $500 a month because you went on a 30-year amortization instead of 25, well, that's increasing your borrowing power by $100,000. And that might mean the difference between you being able to buy that next rental property or not. That's going to be way more important to your future net worth than saving 0.1 or 0.2% on your mortgage. It's really important too at this stage to make sure that you're minimizing or eliminating all other debts. If you already own your own home and you have some other debts like car loans and credit cards, etc., a lot of time we're looking at wrapping up and rolling all of this debt into one bundle in order to eliminate that and lower your overall debt servicing, so we have some more breathing room to buy the next rental property. Another consideration here, and this is a really cool strategy. Going back to that idea that when you're buying a property, you can put 5% down as long as it's your personal residence, and it does not need to be your first home, but it just needs to be a primary residence. The strategy that some of our clients have is, instead of buying their home 5% down and then buying rental properties separately for 20% down, another strategy here to accelerate things a bit is, instead, if you have a high enough income to be able to pull this off, buy a home that would be a good rental property in the future, buy it with 5% down, and then later on, when you're ready to upgrade, then you buy a new residence for yourself and you keep the existing property. And so now you bought what eventually turned into a rental with only 5% down instead of needing to put the 20% down. And so this is a way of being able to generate a rental portfolio more quickly with less capital. The key here is you do have to have a high enough income for it. And in general, the mortgage insurers are relatively tight on how they review these types of files. And so you do have to be a fairly strong applicant with fairly strong income to do this. Another thing that's really important too is that you do want to consider, especially if you're buying a house, consider something that has a suite in it. $1,000 a month in rent is anywhere from about 40 or 50 grand on the low end up to about $250,000 of borrowing power with specific lenders. And so if you buy a home that has a basement suite in it, this can increase your borrowing power substantially. And this is something to keep in mind, is that if you do buy a home and you want to make sure that you're set up and you're able to qualify for future investments, buying a home that has a suite in it can really help quite a bit. So step number 3, let's start to look at now purchasing properties 2 and 3. And in order to be able to assess this, we need to understand, how do you qualify? And so the first method that most lenders use is something called 50% add to income. So let's go through this, and let's assume that you have $1,000 a month in rent. If you had $1,000 a month in rent, the lenders would take 50% of it, so $500, add it to your income, and then they usually want to use about 40% of your income towards all of your debts. And so really, the $500 gets watered down to only about $200 a month that's actually being used to help you qualify. That's not a lot. To put it in perspective, right now with the stress test, so that's the lenders having to qualify you as if your rate is higher than the actual rate that you're taking. The mortgage payments per 100 grand are about $550 to $600 per month. And so this $200 a month is only really qualifying you for about 40 grand, maybe 50 grand of borrowing power in a best case scenario. And it's not helping you a whole lot. Luckily, there are other methods that lenders sometimes use. There's a method called an offset. Most of the lenders that use an offset is about 80% offsets. A few lenders use 90% offsets in certain cases. Some lenders use as low as 50% offsets, but an offset means that they take that percentage, so in this case 80% of the income, and they use it to offset the expenses first, and whatever's left over is a liability or an income, depending on whether it's a surplus or a deficit. So in this case, if you had $1,000 a month in rent, they take $800 of that rent, and then they subtract all the expenses against it first before they do any calculations. Now, in theory, then, you're using $800 of the rent, not only $200 of the rent, like in the 50% add to income method. And in theory, if you had a property where the expenses were $800 or less, then this property would have no net effect on your debt servicing. The way that the 50% add to income works is because they're adding a number to the top line and to the bottom line, there's always a net deficit on each property that you own. It's always going to be a factor in your application. Whereas the rental offset here may allow you to continue to grow the real estate portfolio and be a bit more aggressive with it. And so this is a really important tool. Most banks do not use a rental offset. Most use the add to income. And so it's very, very difficult to build a real estate portfolio with many of the major banks. The last one here is what's called a DCR, or debt coverage ratio. I've gone over what a DCR is in many of my my webinars about commercial lending. A DCR stands for debt coverage ratio, and effectively what this is if you were buying a apartment building or a warehouse or anything that would be considered a commercial mortgage, then banks on that side would usually look at it and say, okay, we want the income to be about 1.2 or 1.25 times all of the expenses for those types of properties. Now, what happens then is if you're building a real estate portfolio, at certain points, certain lenders will say, you know what, this is really more of a business transaction. We want to underwrite it more like we underwrite commercial loans because you're more of a business customer now, and we want to mirror the underwriting guidelines that we use in commercial. And so a debt coverage ratio will often kick in. So certain lenders, it'll kick in on your second rental property. Certain lenders, it'll kick in on your third rental property. But in general, what they're doing is they're using all of the income from the rental property, but they have their own expenses and their own calculations for certain expenses. For instance, vacancy, they're going to use about 5% vacancy, which in some small towns might be better. But when you're looking at a major urban center, a 5% vacancy is actually really, really high. Like in Vancouver, the vacancy is definitely less than 1%. And yet the banks are going to use a 5% expense for that. So it can be a bit difficult in many cases for the debt coverage ratio to work. In fact, in most cases, you usually are not getting more than about 50 to 65% financing using the debt coverage ratio method. So this is really, really tough. And in fact, what we do a lot of the time with our clients is try to avoid these lenders that are using this type of method until very late in the game. Some of these lenders will finance clients that have 10 plus rental properties, but only if they follow the debt coverage ratio method. So it might be a good lender to use for later. Whereas if you're buying your third or fourth rental property, then maybe we're going to be looking at this debt coverage ratio and just trying to stay away from it, because in general, most of the time it will not give us the high amount of financing that we're looking for. So these are all the little things that we're looking at and trying to evaluate, okay, where's the right fit for the client in order to maximize the amount of financing that you can get. So let's look at the second property now. Let's assume that you own your own home for $500,000 now. And now we're looking at purchasing another property on top of that for $500,000, and the monthly rent is $2,500 a month. So if you wanted to buy this as a residence, and you're going to convert the existing one into a rental, and that existing one's going to get $2,500 a month in rent, and this new one's going to be your new residence. Now you need an income of between $135,000 and $155,000 in annual income to qualify for it. So now your income has jumped up substantially in order to be able to pull this off. And again, looking at a 25-year amortization maximum. If you're buying this as a rental, the range varies quite a bit, anywhere from needing about $120,000 in household income up to $165,000. And we're still using a 30-year amortization to make this work. And so there's a bit of a variance here depending on how much income the lender is using from the rental property. You can still see that you might actually need just as much income, basically, or even more, to buy this as a standalone rental, especially if the lender is using that 50% add to income method. So it can be quite weak. But you do have the two options to go with. You might decide, you know what, I'm actually going to buy this standalone with 20% down. Or you might decide, you know what, if I make the decision that I'd like to move into it, then I could buy this with 5% down. I could buy with a lower down payment, and that would allow you to perhaps build your real estate portfolio more aggressively. Let's go into the third property now. So now we already have two. Now we're buying a third one. Now, if we want this third one to be the residence, we're going to keep the other two. Now you need about $150,000 to $200,000 in income in order to pull this off. And if you buy it as a standalone rental, then you need about $130,000 to $180,000 in income. So you can see that now buying it as a residence is becoming harder and harder and less attainable unless you have a very, very high income. So, you know, overall, it does get tougher, especially with the mortgage insurers. They don't like to see that you're over leveraging yourself too much, and you're only putting a small amount of down payment, like 5% down in these cases. So some of the key points you need to look for when you're buying properties 2 and 3 is, first of all, which lenders to use. It's important to have that as a key part of the strategy. You do not want to use lenders, especially if you want to grow a large portfolio. You don't want to use the lenders that are good for 5+ properties, because there's only a small handful of lenders that are good for 5+. Most lenders will do, anywhere from 1 to 5 or 1 to 4 properties, but 5+ is where things get really, really tough. So in general, if there's only 3 or 4 lenders that are really good for like 5+ properties, then those are lenders that you actually want to save for later. Don't use them in the first 5, because most lenders have a rule where it's either 5 properties total max or up to 5 properties with them. If you use one of those few banks that will finance clients that have 5+ or even 10+ properties in your first 5, that's one less lender you're going to have available to you when you go to buy that 6th or 7th property. Another thing that's important too is to try to slowly switch your mindset to understanding that leverage is more important than the rate. We do have this come up a lot where we say, hey, client, you could put 25% down or 30% down and get a lower interest rate, or you could put 20% down and the rate's a little bit higher. The math almost always works out where your total return on investment is higher by putting less down payment and getting a slightly higher interest rate. Obviously, it depends on the difference in the rate, but in general, your overall return on investment is higher with obtaining more leverage. Another key part here as well is buying strong cash flow properties. If you buy properties that are negative, it's going to be even harder for you to grow a real estate portfolio, because again, pretty much every property is going to be a net negative on your application, not a net positive, especially if you're buying properties that don't cash flow very well. So that's something to consider. The other thing I think that I find here is it takes a lot of clients a lot of time to get going when they're in this phase. So when you're buying that 2nd or 3rd property, you already own your residence. We have a lot of newer investors that really fall into the analysis paralysis trap. So they really analyze it. They're trying to find the perfect deal, and a year or 2 or 3 years has gone by and the values have gone up, the rents have gone up, and they've missed some good opportunities. In general, doing an average deal is better than doing no deal at all. And so it's really important to just get comfortable, get confident in making these buying decisions, and know that even just buying an average deal is going to outperform you buying no property at all. Now let's look at properties 4 and 5, and this is where things start getting a little bit more difficult. You're probably feeling good, and you're thinking, oh yeah, this is easy. I'm a real estate investor. This is super simple. Wait until you've been declined by the bank, and this is usually where you start to hit that wall a little bit. Things get tougher, and so I want to talk about what the banks aren't telling you, and some of the struggles that you're going to run into, and also how you can of course work around those struggles. So in your 4th and 5th property, residents 5% down, not happening. The CMHC and the insurers are unlikely, not impossible, but very unlikely to offer such low down payment percentage for your 4th and 5th property. So really, you're looking more at buying rental properties now at this stage of the game. And to buy your 4th and 5th properties, you're probably going to need between 150 to 220 grand in income, assuming again that the properties cash flow quite well. I will say this: $2,500 a month in rent and a $500,000 purchase. You're going to be looking at very specific markets to find this. This is not going to be something you're going to easily find in a major urban center. And so if the properties are more expensive and or have less rental income, then the amount of income that you need is going to be increasing significantly. And by the way, it's going to be a lot higher than just a little bit more than 150 to 220,000. If over all of your properties, they all only generate $1,500 a month instead, well, that adds up. Every property over time, if you have 4 or 5 of those properties that are all cash flowing negative, that really adds a large negative to your application and makes it a lot harder for you to keep growing. And so a couple of the things that you're going to want to be aware of as you get into the 4 and 5 property mix here is that lender guidelines vary and they stack with more properties. And what I mean by that is that if you buy one rental property and the lender's calculations are that the property is negative $800 a month, well, if you have 4 or 5 of those properties, now all of a sudden that negative is either $3,200 or $4,000 per month that your income has to carry. Well, that would require an income of $80,000 to $100,000 a year just to carry the negative on those rentals. Even if to you those properties are cash flow positive or neutral, to the bank they may be negative. And in fact, most of the time they are. And so just make sure that you understand that different lenders have different guidelines. If you go and talk to your bank and they say no, it does not mean that another bank will tell you no. We deal with this all the time where you say, you know what, that lender, yeah, with their policies, they won't lend on more than 5 properties. Doesn't matter who you are. But we have another lender that maybe you can fit with. Maybe there's another lender that doesn't use enough rental income, or a lender that uses a debt coverage ratio, and so you can only get qualified for a smaller loan amount. There's a lot of little things like this that can become more tricky. This is where the DCR, or debt coverage ratio, becomes a little bit more relevant when you get up to the stage when you have 4 or 5 properties. And you need to understand that the minimum down payment might start to inch up and increase on you a little bit. You may need to start adjusting your game plan here, where you might not be able to qualify with just 20% down anymore. You might need to be putting 35 or even a higher percentage down payment in order to qualify. Another key metric here too, when you're buying your first few rental properties, is not as important. The lenders don't necessarily have a black and white way of looking at this, but the liquid assets are definitely put under the magnifying glass and you have a larger portfolio. The lenders do get concerned that at some point, if you do not have enough liquidity to weather a storm, where if all of a sudden one tenant trashes the place on the way out, another place is vacant, another place just had a strata vote to do a special assessment, and then you have to pay $50,000 to fix a water leak in the building, you could have a run on the cash and you could need and require $100,000 just out of nowhere. And so that's where the lenders start to put a bit of a magnifying glass on how much liquidity do you have. A really general rule of thumb is about 30 to 50 grand in liquid assets per property is usually a good number to be looking at. And so that's usually what we recommend. Just to give you an idea, some lenders, once you have 3 properties, need about $100,000 in liquid assets as a general rule or a requirement. Most lenders, it's a bit more black and or a little bit more gray. So it's not black and white. They say, the borrower doesn't have enough. But there is at least one bank that says when you have 3, 100 grand. And if you have each property over that, you need an extra $10,000. So that's kind of their math that they look at. Another thing, most lenders, or many lenders, have a 5 max rule. So either 5 max with them, or most of them are 5 max in total. And so you need to be making sure that you're aware of that and knowing that as you buy these 4th and 5th properties, you're getting up to that maximum and that that new wall that you're about to hit. You should be aware of the fact that you're likely to tap out fairly soon, at least with the vast majority of lenders in the marketplace. So to summarize the strategy here and how to build the real estate portfolio, is all about debt servicing. It's important for you to focus on cash flow property. If you're buying properties that, an example would be a great development site that has a really old house on it, but a big piece of land, and it can be rezoned in a few years, that can definitely work and it can make you a lot of money. The only side of the other flip side of the coin here is that type of property may limit your options in the future for being able to continue to grow your real estate portfolio. You might be all in on that one property until it sells, and then once it sells, then finally you have more cash, you can do more deals. But you have to understand that might restrict your ability to continue to grow your portfolio. The lenders, the number one thing they look at is debt servicing. If you can't service the debt, then they're not lending you the money. It's very, very simple, and it's very challenging as you grow your portfolio to be able to cash flow positive. We recommend taking 30-year amortizations on all of your debt whenever possible. That lower minimum monthly payment will allow you to qualify for more debt. And it's also important to understand that if you have a residence that still has a mortgage outstanding on it, go into 30-year amortization, but then use the lump sum prepayment privilege to pay it off more aggressively. So you can pay off between 15 to 20% of the original principal balance per year with no penalties. So you can pay off the mortgage in between 5 to 7 years using the prepayment privileges and the lump sums. The lump sums, because they're not a guaranteed payment that goes out of your bank account every month, does not affect debt servicing because you get to choose if you're going to do it or not. So this is one of the ways we get a 30-year amortization, keep the payments nice and low, but then at your discretion, make lump sums on that mortgage and pay it off more aggressively. And this will open up more room for you to be able to qualify for more debt overall. Another thing very important, eliminate all other high interest debts. A car loan for 25 grand with a $550 a month payment is about the same as borrowing 100 grand on a mortgage. So it's not about the amount that you're borrowing in the 2 different debts, it's the monthly payment that they look at. And because a mortgage is amortized over a longer period of time, and because the interest rates are generally lower on a mortgage than any other debt, those 2 reasons combined mean that in general, borrowing money against your home or against rental properties is almost always cheaper, and therefore is better for your debt servicing than borrowing unsecured debts or a vehicle loan, for instance. getting a home equity line of credit should be the first thing that you do. Once you've created your game plan, you should be looking at getting a home equity line of credit. Of course, if you've just recently purchased your own residence with less than 20% down, you might not be ready for that. But in general, when we start off with clients, one of the first things you need to look at when you're creating your game plan is, where's my capital going to come from? And in most cases, the easiest spot to get it out of is your home, and usually the most tax efficient way to get it is also your home. And so usually the HELOC is step number one. Another thing, once you've created your game plan, follow it. If you fail to plan, you plan to fail. So something to keep in mind is, create that game plan and then stick to it. And another thing that's important here too is just make sure you surround yourself with experts who understand how to invest in real estate. A lot of accountants and realtors and financial planners, etc., may not specialize in working with real estate investors in particular. It's important to understand that you want to make sure you link up and hook up with people that focus on investing in real estate. It is a very different hat to wear. If you speak to a realtor who sells homes generally to homeowners, he's just say, "Oh, you should buy this home. It's great. It's really close to school. It's got a walk-in closet. It's got this. It's got that." All of these things may be great for somebody that's moving into it and going to live it themselves. But you as an investor, you have a different mindset. You're going to be looking at, yeah, but what is the cash flow? These things are valuable, but only if they produce more rental income on the home, right? And so these are things that are very important for you to be able to assess. And we know, realtors and accountants, et cetera, that are really good at doing the analysis part, which is a very helpful aspect of doing this. Now remember, game plans may vary from person to person, and a game plan for 5+ properties is going to be very different than a game plan for somebody that just wants to buy one rental property. So, we can look at this and it can get very complicated. Things like, should I buy in a company name or not? A lot of this stuff can be very, very difficult to assess and work through. Ultimately, our job is to try and make that as easy as possible and to make it simplified. So who's in? Who wants to invest in real estate? Who wants to make some money? Oh, here we go. I'm so glad that you guys know how to raise your hands in Zoom. So I've got 5. Oh, there we go, guys. All right. Woo! That's awesome. I did not expect that, actually. I did not plan for a whole bunch of you guys to raise your hands. So I'm very excited that you guys did that. That really worked for the Zoom. So on the deal analysis, now that you've kind of understand, okay, here's the game plan, here's what we're going to do here, here's the raw way of building out a portfolio. I want to give you a couple of little hints and tips on doing the deal analysis, because I feel like this is an area where people sometimes get a bit hung up. So first of all, use some shortcuts. It can take a really long time for you to analyze every deal and spend an hour or two on every deal. I've gotten to the point now where if I'm looking at a deal, I use a really couple of quick hints and tips just to narrow down my time to know if I should even take it to the next level or take it to the next step. So here's the first thing I usually look at is the rent to price ratio. If it's about 0.4%, then the deal will probably be about cash flow neutral with 20% down. So this means that if the monthly rental income is $2,000 a month, then on a $500,000 purchase, that monthly rent of $2,000 a month is about 0.4% of the purchase price. The easier math, of course, is the $1 million home. The monthly rental income should be about $4,000 a month or higher in order for it to cash flow. And so that's a really quick mathematical formula that I use to just determine if something is going to be likely to cash flow or not. Another key shortcut that I like to look at is $100,000 equals about $400 a month. Now, if you're in a variable rate, that might be a bit lower. If you're in a fixed rate, that might be a bit higher. So maybe even bump it up to maybe $450 a month. But in general, that really quick math of how much does it cost per $100,000 really helps you. Especially if you're in negotiations with a seller and you're like, oh, I can't believe the seller wants another $10,000. That's crazy. I'm not going to pay that. Well, maybe if you break it down, you say, well, that's $40 a month or $45 a month. Now the deal still cash flows $120 a month, even with that higher payment. Okay, maybe we should reconsider and maybe we should still do the deal. The other way that you want to also look at this too is if you're looking at something that has a basement suite in it. So let's say that you're looking at a home for $800,000 with no basement suite in it, and you have another home next to it that's $1 million but has a basement suite in it. All other things being equal, the home with the basement suite, even if it costs you an extra $800 or $900 per month for the home with the basement suite, Well, if that basement suite generates $1,200 or $1,500 a month for you, then you're net ahead actually on your monthly payments buying the home with the suite than you are without the suite, even though you paid an extra 200 grand for it. So just something to keep in mind, especially if you're buying a home for yourself and you're looking at determining whether you're going to buy something with or without a suite in it. Use tools. Lots of tools out there to help you do analysis. I think it was 13-ish, maybe even 14 years ago. Originally, I built my own spreadsheet to run my numbers on looking at my first rental property that I bought when I was 21 years old. And I, of course, I'm a spreadsheet nerd. So I built a spreadsheet, started using it. And in talking to clients, I realized a lot of clients didn't have anything to use. And so I made it look a little bit prettier than my simple spreadsheet, and then started handing it out to clients. So I do have a cash flow spreadsheet. I'm happy to email to everyone. And that will help you do a quick deal analysis. You punch in the purchase price, the down payment, the income, the expenses. It calculates your mortgage for you. Most importantly, it looks at, okay, what is your monthly cash flow in this deal? What is your total return on investment in this deal? One of the really cool things about a tool like this is if you are looking at two different properties, and let's even say two different markets, for instance, you might be looking at, okay, I want to buy it looking at a condo in Vancouver and a condo in Edmonton. Well, those are two completely different markets. I would generally expect that normally I would expect a higher income on the property in Edmonton, for instance, but I might expect a higher appreciation on the property in BC. Now, I'm not going to debate whether, short term or medium term, the appreciation will be higher in Edmonton versus Vancouver. But if you come to the conclusion that you feel the appreciation may be higher in one market than the other, you can put it into the spreadsheet, and then you can actually get an apples to apples comparison of one property has more cash flow but a lower appreciation versus one that has a lower cash flow but a higher appreciation. Which one has an overall higher return on investment? Sometimes you'll be surprised by the results in running that analysis. But having some kind of tool to help you run the numbers instead of using a piece of paper and a pen probably will help you make better decisions. Another really cool website that I use is www.rentometer.com. And so what you do is you punch in the address, the number of bedrooms it is, and just punch in any rental income number that you think is reasonable. And it'll tell you what the average and median rents is for that market and that area. And it'll tell you what the 25th, 50th, and 75th percentiles are too, which is really cool. So if I'm looking at a brand new property in that market, I'll probably use closer to the 75th percentile for the rents in that area. If I'm buying something that's really old, in really bad shape, and I don't intend on doing renovations to it, then I'll probably use something in more like the 25th percentile. And if it's an average property, probably looking at the 50th percentile. And so this can help you run some quick numbers on rents. I feel like now, being in the business for 15 years, we're all pretty quick now at being able to say, that property probably going to be about this much in rent, and we're usually pretty close within about 10 or maybe sometimes 20%. But it is more accurate for you to use rentometer.com to punch in something, and that'll give you a really good indication of what to use. You can also use Craigslist, but I find that's a bit slower because Craigslist, you have to go through each listing and, is that nicer than mine or not? I mean, these photos aren't really nice, but I think it's just the photographer's really bad. I think the place is actually kind of nice. So that one is asking for this much money. It's just a bit longer. Personally, Rentometer, boom, look at the list. I look through it, and within 30 seconds or a minute, I have a pretty good idea of what the macro data for the market is for the rental income. So I really like using that website. Now what you want to do is you want to quickly filter these properties through. So you want to use specific metrics to calculate and compare the return on investment. So going back to that Edmonton versus Vancouver example, I would probably look at that and say, okay, what metric am I going to use for all the properties in Vancouver market? What appreciation will I use? In general, by the way, I usually use about a 3% annual appreciation for most of my analysis. If I think a market's going to underperform, then I might use 2% or even 1%. If I think a market will overperform, then I might use maybe 4%. I don't like to go much higher than 4%. I think that might be unrealistic long term. Even though the average appreciation of the last 25 or 30 years in Vancouver might be 6 to 7%, I think it's better to use a lower number in a forward-looking analysis. Another thing that's really important too is you want to quickly gain an understanding of a market. I find that there are certain types of products in certain markets that work better than others. So if you're asking me, Kyle, what would you buy if you're buying a place in Edmonton? I would say, you know what, I like the duplexes and fourplexes there because in general, I find that the cash flow as a function of the purchase price is better on a two or fourplex in Edmonton than it is for a condo, for instance. So I'd rather buy one fourplex than four condos. If you're asking me what works in Vancouver, well, a fourplex may not work. It's going to be a lot more difficult for that for the cash flow to work. And so I might say, you know what, in Vancouver, I like condos fully furnished on medium-term leases. So there are companies that, for instance, will do medium-term leases, and they'll have people that had a flood in their home and needed somewhere to stay that's fully furnished, and they need to stay there for a month or 3 months. Also, with corporate rentals coming up and being a thing again. I think that could be a good opportunity. So you just want to gain an understanding of a market and see, you know what, it seems like these types of properties are working better in this market. Well, maybe I'll stop looking at all these others and quickly just kind of filter down to just duplexes and fourplexes in Edmonton instead of looking at everything in Edmonton. This is just a quick snapshot of what the spreadsheet looks like to give you an idea. And again, email us at info@greenmortgageteam.ca and we'll send you a copy of the spreadsheet. Now, I want to give a quick update on some of the things that we've been hearing regarding rental properties and some of the potential rule changes coming down the pipeline. So first of all, money is starting to dry up a little bit. We've had a couple of credit unions start to restrict the amount of financing they're doing for rental properties, and so you have to be careful and aware of that. A couple of the credit unions have said we're not lending outside of our market. And so even if the borrower is within their branch network right now, if you're buying a rental that's 50 kilometers or further away from one of their branches, then they may not do it. We saw one credit union tighten up and actually taper their rental offsets, and so they changed it and actually are using a little less rental income than they used to. Another credit union is only financing their members, and so they're not financing people that are not currently members of the credit union. So they're only financing members for rental purchases. And so I'm noticing the money starting to dry up. It probably won't turn into a situation or a problem with the banks. We've seen this before with credit unions. Back in 2015 and 2016, the market was really hot. Same thing happened. A few credit unions in particular tightened up and started the money started to dry up. It will come back, but one trend that we're noticing. The other thing that we're hearing, which is probably more concerning here, is we're hearing a lot of rumblings that the down payment for rental properties is likely to go up. Long story short, after the subprime crisis of 2008, some international guidelines came out called Basel II, and basically it was something that increased the amount of cash that banks should have on hand for every asset on the books. Basically, you shouldn't have only $1 million in the bank if you have 100 million in assets out there. Same thing where we talked about, if you have a real estate portfolio, you should have a bit more liquidity. The same issue with the banks, because if you have a run on the bank, that liquidity can dry up really, really quickly. So that was one of the things they looked at, but also looked at tightening up the guidelines. Now, my understanding is that Basel III guidelines are starting to come up again. And by Q2 of next year, so we're hearing June likely of next year, the Office of the Superintendent of Financial Institutions is looking at other things they might use to tighten up the real estate market. I have a feeling that what they're going to look at is likely increasing the down payment from minimum 20% to maybe 25%, possibly even as high as 35% down. Now, why would they do this? Last year in 2021, the number of residential properties purchased for investment purposes was 3 to 4 times more than normal, which is not common. Now, part of the reason, of course, is low interest rates, and it just made a lot of sense to purchase investment properties in that type of climate. But that is definitely a major concern for the government. They're also just very concerned about real estate values, and if they make it harder for investors to buy rental properties, then that, in theory, should slow down the market a little bit. So just a heads up, if this happens, this down payment going up is going to decrease your return on investment. We've talked a lot about in the last little while about interest rates rising and how that's going to affect things. The reality is down payment going, especially if it goes from 20 to 35% down, that's going to have a way larger impact on your return on investment than the interest rates rising in the last 12 months or so by 2%, a much larger impact. So that's something to keep in mind. And so we might be in a situation in the very near future where it's getting harder and harder to get a mortgage approved, and especially with a lower down payment. So what are some of our clients doing right now? Especially with the market changing, there's more talk about a potential recessionary period in 2023 with how aggressive the Bank of Canada is increasing interest rates. And by the way, on that note, I think it was last week, I did a presentation, an impromptu webinar all about interest rates. Anyone who would like to watch that can email us at info@greenmortgageteam.ca, and we can send you a link to watch the webinar where we talked all about what's happening with interest rates, because we've had a lot of questions about that. But if we do have a recessionary period by 2023 or 2024, you're not going to be losing your job or having some kind of financial downturn while you're carrying a bunch of debts. And so it's important that you start to restructure and refinance now. Not to mention, we may have hit the peak for real estate values, in particular with detached homes. And so you may be able to access more capital today than you can in a couple of months. Another thing a lot of our clients are doing is learning about how the Smith maneuver can help them save a large amount of money in tax, just with a couple of very simple changes. And so again, if you wanted a copy of the book, then you can reach out to us. A lot of our clients are getting access to capital to invest and earn a spread on their on the interest versus the return. And so if you invest your money at 5% or at 8%, and you borrow against your residence at, let's say, 4%, then you're creating a spread between the earnings and the cost of borrowing of 4%. And that means that you can make money on money that's not even yours. You're just borrowing it from your residence and then lending it back out. And utilizing their home equity to buy rental properties, especially if the minimum down payment numbers change. So all of this information is great. And if you're sitting on the sidelines wondering what you're going to do next and where your life is going to take you, none of this matters. None of this education matters if you don't turn this knowledge into action. And so this is really important that you start to figure out, okay, what's the next step? Maybe I'll reach out to a realtor and connect with them. Maybe I'll reach out to Green Mortgage and start to figure out what I can financially actually afford. And that's really what you should be starting to look at doing is turning this knowledge into action. Another thing I'll mention too is that about 2 years ago now, I set up a real estate investing consulting company where we do a little bit more high-level consulting for clients that need that. And so basically, we're trying to map out and talk to your lawyer, talk to your accountant, just bring everything together. Too often, the mortgage broker is just talking about what they need to talk about. Yes, your income needs to be higher so you can qualify for the best mortgage. But then your accountant says, no, you don't need a high income because then you're going to pay more in tax, and that's not good for the tax person. So it's important, and one of the things we do is kind of wrap up and have conversations with the accountants, the lawyers, make sure that everyone's kind of packaged up in a neat little package and look at a holistic planning. And we do a lot of other things too, like creating a game plan, accountability, property analysis, also doing a portfolio review to look at the winners and losers in your portfolio to figure out which ones you should sell and which ones you should keep. So if you wanted to learn more about investing in real estate and buying your first 5 properties, then book a consult with us today. If you're interested in getting a copy of the Smith Maneuver book, then let us know. Also, I wrote a book called Rockstar Real Estate Investing, which is great for those that, especially those that are starting off and learning about the fundamentals in investing in real estate. It became a Amazon bestseller. And so if you'd like a copy of that book, again, reach out to us and we'll be happy to put a copy in the mail. And we are located in Vancouver. Here's our contact information. You can reach us at greenmortgageteam.ca or info@greenmortgageteam.ca or phone 604-229-5515. Awesome. So I know I have some questions. I'll open up the Q&A first and start going into that, and we can go through this. Roger has the question. So sounds good, but why wouldn't you also consider your monthly cost of borrowing, insurance, maintenance, et cetera, in your ROI calculation? So yes, Roger, in many of my other presentations, I've talked about the overall return on investment in investing in real estate. And so in general, the ROI from just the leverage aspect, if you assume about a 3% appreciation and assume putting 20% down, is about 15%. Most rental properties that our clients are buying are about net neutral on the cash flow. So there's no return from cash flow, just because the income coming in is usually offset by all of the expenses going out. So that would be cost of borrowing, insurance, maintenance, et cetera. So yes, that needs to be included. The other thing that people don't think about actually is the mortgage pay down. And so just having the tenant cover your expenses for you and then paying down your mortgage actually represents about a 7.5 to 9% return on your money per year. So if you take that 7.5 to 9% plus the 15% you're getting from the appreciation, most decent real estate deals usually have an annual return on investment of about just a little bit over 20%, which is quite lucrative. Okay, so question from Angela. For your primary house with a suite in New West, does it have to be a legal suite, and how do you have to prove the income? Great question. Most lenders do not require it to be a legal suite, especially in British Columbia. You'll find this a bit more common in Ontario, where the legal suites are a little bit easier to obtain. And BC in particular, I think well over 80% of basement suites are illegal. So that's something to keep in mind. Now, in order to prove the income, there's a number of different ways and methods that the lenders look at it. Ideally, you have all of these. If you don't have all of them, then ideally you have most of them, and we can find a lender that we can work around it. They generally want to see the lease. They usually want to see 3 months of deposits showing that the money has gone into your bank account. And in general, most lenders will not use the rental income if it's not on the T1 generals. So that is your personal tax forms. Now, if you just bought the home in the last couple of months and you obviously haven't filed your tax returns yet, then that's okay. Or if you just bought the home late last year, but then we're doing renovations in the home and it hasn't shown up in your tax returns and your lease agreement says that you leased it out starting in January of this year, then you're okay. But in general, it should show up in all 3 of those spots. You should have a lease for it, which I highly recommend that you have a lease on your any rental suites that you're renting anyways. You should be able to show and exemplify that the rental income is being deposited into your bank account on a frequent basis. And then number 3, it should be showing up on your personal tax returns. And this is the big one that we find sometimes clients don't claim it, and then we can't use it. Justin asked, do RSPs count as liquid assets to the lenders? In general, yes, because you can liquidate them. Sometimes the lenders will water them down by 30% because that would be the withholding tax to get the money out of the RSPs. However, one of the lenders does not include registered funds as part of their liquid calculation. So the answer is it depends, Justin. Most will consider the RSPs as liquid, but some don't. Yves asks, why change expected in June 2023 for mortgage rule change? Could it be earlier? So yes, the rule change could be earlier than June of 2023, but that is when the new rules are due. So for Basel III, that's when they're supposed to be rolling out, and all the countries have to come up with how they're going to change their guidelines. And so it could be earlier. In fact, if the deadline is June, then what would likely happen is they'll roll it out and say, in maybe February, they say, oh, by the way, this is happening very soon. Your other question, would you recommend buying one property around 800 grand for a fourth property, or 2 $400,000 instead as your fourth and fifth properties? Good question. In general, it depends. So sometimes you'll get more rental income on the smaller properties. So if you buy 2 properties for 400 grand each, then maybe you'll actually generate more total in income. However, in general, it's usually better to buy one property for 800 grand if the rental income is the same as the combined 2 $400,000 properties. Reason for this is that if lenders are counting how many total properties you can own, then having one property for 800 grand is only one property against you, whereas the other 2, that's 2 properties against you. We have some clients with a large portfolio and it's all $200,000, $300,000 properties. Don't ask me where they're finding these things, but cheap $200,000, $300,000 properties. They've got 10 of them and they can't buy anything anywhere. And yet we have some clients that have 2 houses in Vancouver that are worth more than all of those other properties that other client has combined. And yet they still have borrowing power because they're underneath that 5 limit. And so in general, if you run the analysis, and the amount of the total return on investment is about the same to buy the more expensive place, then I would say generally makes sense to buy the more expensive place. It's also less work and headache for you. It's only one mortgage you have to deal with on the renewal. It's one property tax. It's one of everything, right? Olivia asks, it is becoming more difficult to buy properties 4 and 5, or if it becomes more difficult to buy properties 4 and 5, isn't it more interesting to mostly use the BRRRR strategy to keep growing the portfolio? So the BRRRR strategy, for those of you that don't know, is buy, renovate, rent, and refinance. And so In many cases, yes. If it is becoming more difficult, then this can be a decent strategy to build it. The key with any BRRRR strategy is making sure that you are able to qualify to refinance it once all of that work is done. So you just have to have some foresight on that. But if you look at it though, and on the BRRRR strategy, it's not actually that much different than just buying a rental property that has already been renovated and is already at that stage. But the BRRRR does, in theory, if you can put 50 grand of work into it and increases the value by 80 grand or 100 grand, then in theory, you're actually having more capital to work with for future investments. It doesn't always work that way though. Sometimes the appraiser will not agree with you that you put 50 grand in and now it's worth 100 grand more. Sometimes they say, well, you put 50 grand in and now it's comparable to other properties where they're worth 50 grand more. So if you watch out that you don't always get more capital out in those situations. So Heen asks, can we qualify for mortgage without sufficient or no income but putting more down payment? So it is very difficult. There are some net worth programs available where you have to have at least a low income. Usually no income is very, very difficult. You usually have to have a low income, but they will use the net worth to top you up dollar for dollar. And in general, these net worth programs require 35% down payment or more. So that's something to look at, but there are some special programs for, in particular for net worth clients. Otherwise, if you have a large amount of capital for down payment, but don't have a large income, then you may be needing to go to B lenders or private lenders if you don't quite fit within the net worth program guidelines. Michael asks, do banks look at property tax, strata fees, maintenance, et cetera, when deciding qualification amounts? Property taxes and strata fees, yes. Maintenance, they usually just use a percentage. So they use a certain percentage of the property value, anywhere from 5 to 15% is typically what you'll see for that. That is one of the reasons that the offset exists. Instead of the lender looking at specifically every single property that you own and exactly what expenses you have on that property, they just say, you know what, they're just going to chop 20% off the top, and that's the estimated amount for things like your maintenance and vacancy, all those types of things. But property tax and strata fees and heat are the things that the lenders almost always include in their calculations. And a few of them will look at your tax returns, the T1 generals, and they'll look at something called the statement of rental activities, and they'll see what expenses you had on that property, and they'll use those actual expenses. But most banks don't make it that complicated. It's usually just the property tax, strata fees, and heat, and plus, of course, the mortgage. I have a question. How do you overcome the issue of having to pay the interest on a HELOC when you use that for down payment in terms of it killing cash flow? That's absolutely a challenge. If you're borrowing, here's a way to look at it. If you're borrowing 20% down from your HELOC and then 80% mortgage on the property that you're purchasing, you're effectively borrowing 100% of the asset value. It's not really reasonable or realistic for you to expect that you're going to borrow 100% of the asset value and then still cash flow positively, right? This is something that is not easy to do. It is not impossible, of course, but it is not easy to do. And I don't think that it's reasonable for you to expect that it will cash flow positively. Now, the lenders, when they treat this, if you're borrowing against your HELOC, then that's your personal income usually needs to carry that. And then the rental properties usually need to cover themselves. That 80% mortgage that you got, usually they like to see that ideally, you know, if it's an offset that they're using, then at least 80% of the rental income covers all the expenses. But yes, it does make it more challenging. If you're borrowing all of your down payments all the time, then you're going to have more stress in your debt servicing for sure. Don mentions, I'm 80 years old with 5 mortgages, all rentals. I will need 6 next summer. Perfect, Don. Let's talk. Another question. If you buy a house with a suite and you rent the suite out, how can you deduct part of the mortgage interest on your taxes? So this is possible. You can deduct some of the expenses on your taxes. In fact, in general, what you look at is what is the total footprint of the basement suite. If the basement suite is 20% of the total footprint of the property, then you're usually deducting 20% of your utilities costs, 20% of your mortgage interest costs in your mortgage, your 20% of your property taxes, et cetera. So you do want to talk to your accountant about that to make sure that that you understand all of the deductions that you're able to claim. Awesome. I'm just going to take a look at some of the chat too to make sure that I don't have any other questions missing. And I've got one more Q&A. Oh, there we go. I think I already answered that one. Okay, cool. Here's a question from Michael. So can money be taken out of a HELOC to invest, be channeled through a TFSA and still qualify for the interest tax deduction? So the answer is no. So if you are taking money off of your HELOC and investing that into a government investment vehicle, so if it's a TFSA or an RSP, for instance, then you do not get to claim the deduction because you're effectively getting two different deductions at the same time. So there's one area where that doesn't work. Adele was asking, what is considered high income? This really depends on how much debt you're carrying. So to put things in perspective, in general, every $100,000 that you're borrowing requires about $20,000 in annual income to qualify for. Michael, to answer your question, so does anything change if you're investing through a corp? Then yes, in that case, if you're borrowing money from a HELOC and then lending it to your company, your corporation, then you and your company have an agreement where the company is now paying you interest or whatnot, and now you're able to write it off. And so you want to talk to your accountant about structuring that properly because it's really important to have the right structure and perhaps even paperwork on that. But you can borrow money from your HELOC and then lend it to your company, and that creates a personal tax deduction if it's done properly. So make sure you talk to your accountant about that. If you buy a house with a suite and you're renting it out for income, how would you deduct it? Okay, we already answered that one. Where would you get property for $500,000, which gives rent $2,500? I want to buy that. Yes, I know a lot of people want to buy that. I use that as an example because it was simple and easy. A couple of areas that you might want to take a look at. There's some areas of Vancouver Island that sometimes can see that, like if it's in Campbell River or a smaller market like that, you might find a property could be in that range. Port Alberni, perhaps. Another market that's very intriguing is Prince George. It's the hub of northern BC, effectively, even though it's kind of in the middle of BC. You could probably find properties there for $500,000 that rent for about $2,500, or $550 that might rent for $2,800, etc. So the rents as a function of the purchase prices are quite good in Prince George. So that'd be an area to look at. Kamloops is a bit more expensive, but also generates a bit more rent. So that's another pocket to consider. Edmonton, you can probably get properties that are in that type of rent range as well. So there are some different options. Let's see here. Just going to see if there's any other questions that haven't been answered. There were some guidelines, or the question from Michael about, do these guidelines also apply to commercial properties that are 5+ units? So I don't know what I was talking about specifically at that point. However, just to explain how commercial lending works, commercial lending is based more on the properties and less on the individual. And so they usually want to see that the debt coverage ratio is 1.2 or 1.25 times all of the expenses. And so this can be better or worse depending on the borrower's strength. If you have a low income, but the property you're financing has a high income, then commercial lending can actually be better for you. In general, however, we find that the biggest challenge with commercial lending is that the loan to value, so the amount of financing you can get as a function of the value of the property, is usually quite low in commercial. We had a client that was refinancing a warehouse a little while ago, and the property was valued at over $3 million, and we could only get a mortgage of maximum $600,000, at least until the rent has increased on that property. So that can be a big challenge in the commercial side, is that you may need a larger down payment. Michael has a question, do banks look at vacation rental income like Airbnb? Yes and no. So I actually did a presentation specifically on financing short-term rentals because this question comes up quite a bit. In general, financing the short-term rental property itself, usually it's very difficult to get the lenders to use Airbnb income. But when you're not financing that property and you're financing another property, a lot of lenders will actually use a short-term rental income on a non-subject property. So if that's not the one that they're financing, then it's easier to use rental income from it, which is kind of odd. In general, banks just don't like financing short-term rentals, but they're fine if you're financing a long-term rental and you just happen to have another property that is a short-term rental. So there's a lot of things that you have to be aware of when you're buying or financing short-term rentals. They are a lot more difficult to finance. But once you own it and it starts to generate even more rental income, then in some cases, it can actually help your portfolio, because in general, you're usually getting more rental income. I don't think the lenders have quite figured out how to wrap their head around how to evaluate short-term rental incomes and how to assess the risk, because it seems kind of unreasonable that they don't want to finance short-term rentals at all if they think or know that it's a short-term rental. But also it's kind of silly that if you already own it, they're using way more rental income, because they just take the gross income amount and then divide it by 12. So whatever the gross income amount is on your tax returns and dividing by 12, well, that's going to be a really high number. But an Airbnb or any VRBO or whatever has a lot more expenses associated with it, so they're not really registering that properly, in my opinion. But that's typically that's how they look at it. In general, should one pick cash flow or appreciation, all else equal? In general, cash flow. If the total return on investment is the same for both properties, I would generally say that cash flow is better because it's safer for you. It'll allow you to buy more properties, and it also has less downside risk, because appreciation is often flat, and then it pops up. Well, what if during that flat period of time, you're paying into it each month because it's not cash flowing positively, and then you lose your job? Well, now you can't afford to continue to pay into that property. But if you had a property that's putting money in your jeans consistently all the time, then you would probably hang on to it and realize the appreciation later. So if all else is equal, then I would usually pick cash flow instead of appreciation. Michael has a question. If you're a non-Canadian but have a Canadian bank account, does your qualification process differ from Canadians? Yes, it does. And so this comes down to, in general, you often will fit into a non-resident type of program if this is the case. So if you live outside of the country and or you're earning an income outside of the country, then you often have to qualify under a non-resident program. Now, if you're buying in Canada and you're moving into the property here and you're getting employment here in Canada, that's a little bit easier. There are new to Canada programs for that. If you're a US resident buying in Canada, or if your income is derived from the United States and you're buying in Canada, you can still get up to usually 80% financing with many of the banks. But if you're a non-resident in let's say China, for instance, then often they only go up to 65% financing. So it actually does depend on your income and which country you're coming from. If you have a $300,000 Scotia Step HELOC, so Scotia Step is the Scotia Total Equity Plan, so that's just our home equity line of credit product. Could it be converted to a Smith Maneuver mortgage, and does it have to be the full amount, or could you split or segregate the HELOC mortgage, say 150, 150? So actually, you don't need to do anything to start the Smith Maneuver. It just that what you want to do is when you start borrowing against your residence to invest, then usually what you want to do is you want to have it separated so that your personal mortgage you use to obtain the property. What you want to be able to do is you want to say this mortgage is not tax deductible, this is over here. But anytime you borrow money against it to invest, then you usually want to have that as a separate segment. And so a lot of the time people start off with one mortgage and one line of credit, but then eventually what happens is they say, okay, I'm going to borrow 100 grand out of my 300 grand line of credit limit, and that's going to be used for investment. Well, maybe what you want to do is actually lock that portion into its own mortgage term, because you get a better rate on it, and it also now separates it. So now you have your personal mortgage, you have the tax deductible mortgage that it was used to invest, and then you still have the 200 grand left available for the line of credit. And then maybe in the future you borrow again against the line of credit, and you can have different segments inside of it. Then when you go to your accountant at the end of the year, you can say, okay, this portion was my non-tax deductible mortgage, but these two were tax deductible, and then it's easier for the accountant to be able to track it, and better if you ever get audited by the CRA too. All right. Gustavo says, wow, full service. Thank you, Gus. Awesome. One other question here. Oh, I think I've answered that one. So the property cap only applies to properties you own in your personal name. So technically it applies to properties that you own personally and in a company name. However, in some cases, if you get business loans, so small business lending or commercial lending, those are business debts, not personal debts. And usually you still disclose those to the lender, but they typically will, most lenders will actually remove those loans from the equation. We've actually been using small business lending a lot more because those mortgages don't report on the personal credit bureau. You pay a bit more of a premium on the rate and the fees, et cetera, to do that. But it doesn't report on your personal credit bureau, which means that you still have more personal borrowing power available for the future. So that's one of the ways to look at that, Kathy. I've got a question here. Is it a good move to buy first property as primary residence or rental if I want to start as a real estate investor? As in, can we buy a primary residence under a business name? So it's kind of two questions, but the question of should I buy a residence or a rental first, to be determined. It really depends on your personal living situation. It also depends on future qualifications that could make a difference. So that's a hard question to answer without seeing more information about your situation. For instance, if you pay a really low amount of personal rent in a very expensive area, there's some areas of Vancouver, for instance, where the rent to the prices is just completely out of whack. It would make sense to continue to rent because of the capital investment you need to make in order to buy a home in that market. But in many cases, owning your own home does make sense. That's usually the best spot and one of the best investments you could make. Now, buying the residence under a business name usually is not what people do. I do have a couple of clients that will start to that will consider that. However, you're going to lose one of the best tax advantages, which is the fact that there's no capital gains on the appreciation on a home that is your primary residence. But if you buy it under a company name, then the company will pay property transfer tax or will pay capital gains when that asset is sold. So in general, you should generally have a property in your portfolio that is your primary residence in general. One question from Daniel. Hi, Daniel. We were thinking of selling our property, but now after listening to you, I feel like I should invest to increase my net worth, invest in more properties. I mean, yes, the return on investment is quite solid in investing in real estate. And of course, I'm a bit biased. Hey, I'm not gonna lie. I've been doing this for 15 years, but I've helped a lot of people build a lot of wealth using real estate as, you know, at least part of or often their main source of investment and wealth building technique. So there's lots of different ways to build that, but yeah. David, hey David, how you doing? Do you have links to previously recorded webinars you've done? Yes, on my website we have a number of different recordings from previous webinars that we've done, so you can watch any of those and just by going to our website. I've got a question in the Q&A. As a couple, each with strong income, good credit, should we acquire mortgages together in both names of say 5 to 8 properties, or get mortgages individually, say 4 each? Which way would be better for the banks? Really good question. This comes up sometimes. So one of the challenges that you run into, because in theory, what you say is, okay, if the lenders say 5 properties max, well, what if you just split up the couple and then each go out and buy 5 properties each? And in theory, then you can own 10 properties without hitting the wall. And this sounds like a really good idea. The only 2 problems you're going to run into is, number one, some lenders say, hold on, we want to see the whole household. Who's your, you know, who's your better half? We want to include both of you in this to make sure that you're not we know exactly what's happening with your household, because realistically, whatever your husband or wife is doing is going to affect you too if they have a bunch of debt that is out there. So they don't always like to do that, but sometimes it will work. We have been able to make that work. The biggest challenge usually, however, is 2 things. Number one, you usually have some shared debt. If you separate yourselves, you still have to service all of the shared debt as if it was just your debt. So as an example, if you have $1 million mortgage on your personal residence and you have 2 high income earners covering that, then it may not be a problem for the 2 of you. But as soon as you remove one of the high income earners, now all of a sudden you have 1 income earner paying for the entire mortgage on your personal residence, and then also trying to qualify for a bunch of rental properties, which might strain the debt servicing and make it difficult or impossible for you to grow the portfolio that way. The other issue too that comes up with debt servicing is it's uncommon that both borrowers make about the same amount. We often have it where one earner is a bit higher and the other earner is a bit less. Well, if we remove the higher income earner, now we have a smaller income earner also carrying all of the household debt and then trying to buy a bunch of rental properties, and that's usually where you run into a bit of a challenge. So in theory, your suggestion is a good suggestion. In practice, it often is not the method that we propose because it usually doesn't actually result in you qualifying for more. It just results in the same or less. Lena has a question. If you take money out of your HELOC to lend, is the interest you pay tax deductible since it's an investment? Is that also the case for using it for investing in something like private equity for a mortgage company like Neighborhood Holdings? So yes, in these cases, it should be tax deductible. If you're investing the money and lending it out and being a lending partner, then yes, it should be tax deductible. And also investing into a private equity company like Neighborhood Holdings, who I know very well, would also be something that should be tax deductible. So talk to your accountant, but both of those should qualify to take out your HELOC and write off the interest that you're paying on that. Fermin has a question. Hey, Fermin, are stress test rates going up? They are starting to go up, yes, because what happens is the stress test is based off of your rate plus 2%. Or 5.25%, whichever is higher. We've already eclipsed this where fixed rates are around the mid 4s. Well, that's in the mid 6s now for the stress test if you take a 5-year fixed rate. If you go with the variable rate, we have been for the longest time been underneath that 3.25% interest rate, meaning that 5.25 is 2% higher than 3.25, knowing that if the interest rates are lower than 3.25, then we're always just using 5.25 for the stress test rate. However, we're starting to get into that threshold now with the Bank of Canada going up another 0.5% earlier today. We're starting to get in a situation where some of the lenders are actually going to have a variable rate mortgage that is going to be higher than 3.2%. 3.25%, which means that the stress test rate was going to be higher than 5.25. So this is going to be definitely increasing the stress tests moving forward, which means that people will qualify for less money now than they used to. Question here: does it make sense to take 2 HELOCs for 368 grand to make a purchase of around 800, or just one 200 grand HELOC instead and the rest mortgage to buy a rental and remainder on a mortgage? I'm just going to wrap my head around the question here. So 2 HELOCs for 368 grand to make a purchase of around 800, or just one 2 grand HELOC and the rest mortgage. Okay, so what you'd want to do here is, in general, you would want to get as much money secured by the property that you're purchasing as you can. So in this case, I would just borrow the down payment from your HELOC and then get the mortgage on the rental property itself and get as much as you can in the mortgage. Because if you took out 2 HELOCs on your residence for 368 grand each, let's say, now you have less money available to borrow to do an investment in the future. And remember, you have that line of credit available to you and already approved. You don't have to reapprove yourself later to reborrow it. It's really nice to have that availability in your line of credit to just tap into whenever you want it or need it. So we almost always recommend that you get as much of a mortgage as possible on the rental that you're purchasing, and then just borrow the down payment from the HELOC. All right, let's see what other questions we have in the chat. How do we evaluate pre-construction properties using original purchase price or new purchase price? Yeah, interesting observation here. So it depends on what you're paying for it, really. If I'm doing a cash flow analysis, I'm looking at what the cost is for me. And that does mean that sometimes a pre-construction property is going to have a lower cost base if I look back to what I originally paid for it versus what I'm closing on it now. But my cost base is what's determining my down payment, is determining all of these things. Now, one thing that gets a little bit more complicated here, Adele, is we do, and something that I've been doing in my consulting company is looking at, okay, well, if you bought it at a low price, but now the price has gone up a lot, we also look at like which properties should be restructured, refinanced, or even sold, because maybe you now have a ton of equity locked into that property and it's not the highest and best use for that equity. And so in some cases, we'll look at that and say, you know what, your return on investment in that deal, because you have a $400,000 mortgage on a $2 million home. Well, if you sold it and took that 1.6 million and invested it in a bunch of other things that you can get more leverage on, maybe you'd actually have a higher return by reinvesting the capital into something else. And so we always look at like what the highest and best use of that capital is, and sometimes that can mean refinancing or selling a property in order to do that. So I'm not sure if that completely answers your question, but it depends on whether you're looking at the analysis to buy it, or if you're looking at the analysis to decide if you want to continue keeping it. But if it's to buy it, always look at what you're paying for it. Awesome. I've been talking for a really long time, and my throat is starting to get a little sore. In case you guys are wondering why I keep going to sip some water, but it looks like you guys have started to dry up on the questions, which is great. If anyone has any other questions, reach out to us, info@greenmortgageteam.ca. I hope you enjoyed the presentation tonight, and look forward to seeing you guys next month. The next presentation is about buying 5+ properties, and that will be again the first Wednesday of every month. So that will be July 6th at 7 p.m. Look forward to seeing you guys there. Thanks a lot. Bye now.